utilizing our capacities over the next 2 years, which will also help to organize our sales volume going ahead. From a product basket standpoint, we continue to witness a positive traction in inquiries of APL Apollo water storage tanks. We have already doubled our capacity for water storage tanks at our Secunderabad plant and also commissioned our production line in Tumkur to ensure that we can increase demand. We have identified a strong business segment for this. We have also identified a strong business segment for us, which is fast settings. This is highly segmented industry, which will give potential for Apollo to emerge as a leading brand. Margins are superior in this segment. We are confident that this product, along with our other value-added offerings like fittings, solvent, cement, and adhesives, will enhance our reach and strengthen our sales going forward. To conclude, I would like to state that we are constantly working towards enhancing our presence across the existing and new potential geographies. Once we complete popularization of our plant, we expect to address the untapped and high potential market of Eastern and Central India as well. Going forward, we expect to deliver a robust performance in the quarters to come and further gain the momentum on the back of improved totality and extension in geographical areas and better brand acceptance. On that note, I would now like to invite Mr. Ajay Jain to run you through the key financial highlights for the Q1FY2022. Thank you.
Good afternoon, everyone. I will briefly cover the financial performance during the quarter of Q1FY22. The company delivered a linear operational and financial performance during the quarter due to constraints like countrywide pandemic restrictions and sluggish domestic demand. Sales volume for the quarter stood at 10,402 metric tons, decreased marginally by 2% YOY as against 10,633 metric tons, which was 80% of sales volume of Q4FY21. Revenue from operations for the quarter stood at 137.6 crores as against 92.5 crores in Q1FY21, higher by 49% YOY. On the profitability front, EBITDA for the quarter grew by 182% YOY, which stood at 17.4 crores as against 6.2 crores in Q1FY21. EBITDA margin, which stood at 12.7% in Q1FY22 as against 6.7% in Q1FY21, higher by 598 basis. Going forward, we anticipate EBITDA margins to normalize from quarter 2 onwards. Interest cost stood at 8.8 crores, up by 338. Interest cost stood at 1.1 crores in Q1FY22 as against 2.1 crores in Q1FY21, declined by 50% YOY. PAT for the quarter stood at 8.8 crores, up by 338% YOY when compared to 2 crores in Q1FY21. PAT margins for the quarter stood at 6.4% as compared to 2.2% in Q1FY21, higher by 420 basis. Last but not the least, I'm happy to share that our company is not leveraging our balance sheet for any extension projects. I believe our cash flow to this going ahead will improve on demand and productivity. Moving forward from Q2FY22, we are discontinuing quarterly volume disclosure ahead of quarterly results due to sensitivity of data. So with this, I would now request the moderator to open the forum for any questions or suggestions that you may have. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhargav from Kotak Mutual Fund. Please go ahead.
Yeah, good afternoon to you and congrats for the good performance.
Yeah, thank you.
My first question, sir, is on the volume breakup. Is it possible to share the volume breakup between agri and non-agri? Because our volume decline is just about 2%. Just wanted to know how has been the breakup between agri and non-agri.
Between agri and non-agri, the ratio is somewhere around 55% will be the agri business and 45% is the building products.
And is it possible to share the YOY volume growth for agri and non-agri?
YOY for quarter?
Yeah, for the quarter.
Hi, Bhargav, Anubhav here. So when we say that 45 building material in Q1 and 55 agri and infra, this is with the fact that Q1 is seasonally heavy for the agri side. Otherwise, this would have been like 50-50, what we closed FY21 at, right? And in terms of value growth, the building material revenue has grown at 50% on YY basis. Because the proportion was very low in Q1 of FY21 because of lockdown and heavy sales from the agri and infra side in Q1 FY21.
And how about the agri portfolio? Has it declined in double digits?
No, even agri we have seen double-digit growth in Q1.
So value growth.
Value based, yes.
Yeah. Secondly, is it possible to know what has been the operating cash flow and free cash flow generation in the first quarter and how was it on a YY basis?
So on cash flow basis, we are still a net cash company. Our net cash stands similar to what was there on 31st March 2021. Except that there is a slight increase in the working capital because of the lockdown restrictions what we witnessed in Q1. Otherwise, the operating cash flow to EBITDA, if we remove the increase in inventory, that remains same what we witnessed in FY21.
On the branding side, how are we looking at spending in FY22? I believe we've appointed a couple of new brand ambassadors. So how is the branding spend likely to pan out?
So Bhargav, see, I mean, if you look at our ad spends so far, right, which are mainly focusing on below the line branding campaigns, right, we are spending anywhere around 1 to 2% of our turnover. Okay, depending on like which campaign goes in any specific quarter. With our focus now turning on above the line aggressive campaigns with appointment of Bollywood celebrity, etc. We should be looking to spend around 3 to 3.5% on our full year FY22 revenue estimate, which we believe will give us a very strong and aggressive ad campaign to come up with.
Okay. And lastly, how is the plastic bottle business doing? I believe we are sort of now away from the gestation period and now the business is looking like coming on stream. So is it possible to share the size of the business, margins in this business, whatever you can share?
So Bhargav, I mean, this is something that we are very excited about as we speak today. Right, what we have seen is that this industry is highly fragmented. Okay, with the absence of large, formal, organized players. Okay, where we think that we can fill a big gap. Okay, which has been there in this industry with superior margins. So we have been adding new product range at our plants. Right, our focus, our target was to generate like 5% of our turnover from this segment, which we believe can potentially be above 10% now. Okay, so we also appointed Bollywood celeb specifically for this segment with enhanced packaging and revised brand campaign, so which is yielding very good results, and we are hopeful that this business could be a very big revenue lever for Apollo, and it will help us meet our target of 1,000 crore turnover on a sustainable basis.
This 10% of revenue target is by what period? FY23 or FY24?
I mean, if things go as per the plan, you might see us hitting 10% of turnover in FY23 itself.
And is it fair to say this has higher margin than the pipe business?
Yes, it has.
Okay, I'll come back in the queue. All the way.
Thank you. We'll move on to the next question. That is on the line of Shaleen Kumar from UBS. Please go ahead.
Yeah. Hi, thanks for the opportunity. So just first of all, just an observation. When I was going through your presentation, you have 1,500 SKUs and you're talking about 2,500 SKUs. While your expansion plan of capacity of 125,000 is already there. So, will you be able to launch these extra SKUs from your existing capacity, or you need additional capacity for that?
Actually, yeah, marginal capacity additions will be there on account of such products which we are adding up. But mainly, we are working on the fitting side, which has high volumes, high margins. So you can say value-added such products will be added, the molds will be added, which will be run on the same machines which are already there in the plant. So maximum investment will be there on the molds, which we are planning for increasing this SKU.
Right, sir. And so what kind of capex are you looking at for, let's say, next 3 years? So let's say you are targeting 20-25% growth. What are the capex you are looking at, let's say, for next 3 years?
We are targeting a capex of around 20 to 25% of the EBITDA level per year over the next 2 years, unless we get any very good opportunity to diversify our business. Otherwise, we will be sticking on the same level of 20-25% as regular investments on the SKUs or other normal machines.
So no major capex.
No major, because we already have the capacity with us to enhance our sales to 1,200 crores or 1,300 crores. So we don't actually need to reach the first target of 1,000 crores for capacity. We need to invest in the capacity for achieving this target. So whatever the target investment we make in the coming future, it will be adding up the target for the coming year. So right now we don't need actually any major expansion or major capex for the current target.
Right. Just what's the just a primitive question, like what's the sales breakup for us? Like if you see in terms of the customer, like proportion of B2C versus B2B customer segments?
We are maximum, you can say, supplying to B2C only. Our major focus is on the retail and the trade sales only. Our B2B is very low because we are not very much interested to contractor sales or other such sales, because there is no such permanent, you can say, that stability is there. Any new company can come and drop their prices and take over the business. So that is not our business model. So we are much more focused towards trade sales and the retail sales.
Right.
Just to add here that the medium through which we sell our products is 90% B2C. Okay, now within B2C, okay, within that there are two kinds of applications where our products go. One is agriculture and infrastructure. Second is building materials. Right. So today, 50% of our products go into building material space, and 50% of our products go into agriculture and infrastructure space. But the medium to sell these products is 90% B2C.
Basically via distributors, right?
Via distributor network.
Yeah, distributor. Right. Okay. And in terms of the concentration or strength, are there like specific areas or tiering of the towns where we have strength or where we are targeting? Like we see that there are very much possible gaps in certain region of the country, or maybe the towns like tier 2 towns, tier 1 town. Obviously, irrigation would be in rural areas, but building material and infrastructure.
So Shaleen, I mean, if you look at Apollo Pipes today, majority of revenue is coming from North region still, right? Because we started expanding into pan-India markets from 2018 itself. Okay, first plant we put up in West India, then we acquired Kisan molding plant in South India. Now we are just on the verge of starting our fourth plant in Raipur, which is Central India. So for Apollo Pipes, we have fairly good potential to to expand our sales into these geographies because we are very new here, and with the focus more on distribution expansion and retail penetration, we are getting good response, and which will be fueled with our ad spends, which will go up in FY22, and our consistent or constant addition of products into our SKU portfolio. So this is giving us a good opportunity to keep on expanding and grow our sales. This is like rural or urban. In building materials, mainly you are selling your products in urban and semi-urban centers. Agri and infra is mainly semi-urban and rural area, right? We still think that there is maybe scope of new capacity to further expand in the west market, because Maharashtra is a very strong market for PVC, which we may evaluate at some point of time. But I think for us to grow within the closer markets near to our plants, I think our business plan of 1,000 crore turnover should be achieved by constant distribution network into areas near our plants.
Understood. All right, Anubhav. I'll get back to the queue. Thank you so much.
Thank you. We'll move on to the next question. That is from the line of Shrenik Bachawat from JM Financial. Please go ahead.
Hi, sir. Thanks for the opportunity. So could you please help us understand what will be the sustainable gross margin level going forward?
The sustainable gross margin will be on the same line of 13 to 14% that we are targeting right now, because of the most focus on value-added product sales. So we are trying to maintain the same gross margins in coming quarters and years.
So this is EBITDA margin.
Yeah, we are talking about the EBITDA margin right now.
And for gross margin to be sustainable? So 14% EBITDA margin.
Yeah. So I mean, we have been talking about EBITDA margins with the investors and analysts. Okay. The reason is that it also takes our sales promotion and ad spends into consideration. And just to answer on gross margin front, it's a clear function of constant increase of value-added products to our turnover, which is mainly driven by building material products such as CPVC, more fitting sales, solvents and adhesives, water storage tanks, and plastic bathroom fittings. So gross margin should constantly move up, and at EBITDA level, the target which our business plan suggests is that 13 to 15% kind of EBITDA margin on sustainable basis is possible.
And so our new greenfield plant, when will started operations?
You mean the Raipur plant?
Yeah.
The Raipur plant is just on the verge of getting commenced. It's just that we are waiting for small and final approval from the local authorities, which should come over the next few days, and then we are ready to go.
Okay, thank you very much.
Thank you. The next question is from the line of Ankit from Bamboo Capital. Please go ahead.
Yeah, Anubhav, I missed the answer on the volume degrowth on the agri side, if you can repeat that.
No, there was no degrowth. There was double-digit growth.
I'm talking about volume, not value, because realizations have increased significantly.
Volume was flattish, okay, at 10,500 ton. Okay, there was a marginal 2%. So let's assume that is flattish. The reason the volume was flattish in Q1FY22 was that in Q1FY21 there were heavy sales coming from the agri and infra side, because the government had started spending heavily on the agriculture after the lockdown restrictions were lifted, right? So that gave us good volume, right? And the revenue was around 950 million INR versus like in Q1FY22, our volume remains almost same, and our revenue value-wise inched up to 1.3 billion. Right, so this explains the shift of our sales from non-building to building material, and this journey had been throughout in FY21, right? Q2, Q3, Q4, Q1. and it has been consistently around 45 to 50%, our building material volume, which was like 30% in Q1 last year.
Sure. And on the volume guidance part for this year, you are targeting 25% CAGR volume growth over the next few years. So how does this year look like, given we are seeing degrowth in Q1, and any idea on or any feedback on how the Kharif sales in Q3 for the pipe season for the agri pipe season looks like?
So I guess for us, our business plan, how we are looking at it as that we are targeting revenue, okay, and then volume is the derivative of that, okay. So to achieve 1,000 crore turnover, what kind of product portfolio, what kind of sales mix we have to achieve, right? So that's how we are going about it. We think that today the platform what we have created, okay, it has potential to give us 30-40% revenue growth in FY22 and FY23 consistently, right? And the volume growth could be high double digit here, right? But the majority of value will come from the sale of value-added products, which are like better superior realization, which are better margin products.
That is true, Anubhav, but you would also realize that PVC prices have increased significantly, and that would also aid realization part even on simple PVC pipes. So volume growth for this year, do you expect we can in the next 3 quarters, if we don't see any significant hit because of third wave of COVID, do you expect double-digit growth in volumes?
So like we clearly said that we are looking at high double-digit volume growth for next 2 years, right? And see, when we say that the revenue growth will be 30-40%, the EBITDA growth will also be same, right? If I am considering the high realization on the back of high PET prices, right? High PVC prices, then my EBITDA wouldn't grow at the same pace. So I'm saying 30-40% revenue growth, 30-40% EBITDA growth. That's how we're going to achieve 1,000 crore turnover over the next 2 years.
Sure. And on any inventory loss because of PVC prices coming down in the quarter?
Yeah, there was some inventory loss, but that was not too much because we were trying to increase our sales on building products, through which we were trying to mitigate the loss of and marginal loss of the inventory loss in this quarter. But again, going forward, the prices have rebounded, and we don't see any major inventory loss in coming days also.
And moreover, I think, rather looking at like quarterly inventory plus minus, what we believe is that today we are capable of delivering 13 to 15% EBITDA margin on sustainable basis, irrespective of fluctuation in the PVC prices. Okay, so PVC prices are going to be like plus minus every quarter, every month, right? So what we do